Okay, great. Well, thank you everyone for joining. My name is Roxy Jahangiri, and I'm coming here live from WeWork in downtown Washington, DC. I'm part of the DC Startup Week team and so excited to have you all participate in today's programming. Thank you for joining us. DC Startup Week is a 5-day conference every September focused on building our startup community. So we're really appreciative for you to be here. We want to give a quick shout out to our title sponsors Next, Insperity, WIS, and Technology Rivers. Thank you guys so much for your support. You're all on mute right now, and the speaker Tommy White will be speaking on how to build a 3-year financial forecast for startups today for today's program. We're so excited for him to be here. He is also the Director of Incubation at American University and has been a huge part of the DC Startup Week family for the last 3 years. So Tommy, thank you so much for joining us today. And please, everyone, welcome me in joining Tommy, and pass it off to you.
Great. Thank you very much, Roxy. Appreciate the warm introduction here. Good morning, good afternoon, good evening to everybody, depending on what time zone you're in today. I hope we'll have an interesting session today. I have to say we're going to dive right down into the weeds really quickly here, really fast, so we can jump into things and just start playing with the financial model. So first thing, a little housekeeping thing, if you open up the chat room function, you will find the Dropbox link in there for both the template model as well as the a sample that we'll be going through also. So these are for you, so you can take them down and drop them down and use them at will. Couple quick things before we get started. I want to do a quick little chat storm. So on a rating of 1 to 5, how would you rate your Excel skills? 5 meaning fantastic, 1 meaning terrible. Okay, 1 meaning fantastic. 5 meaning fantastic, 1 meaning terrible. All right, so a lot of mixes here, a lot of 3s, 4s, 5s. Good. All right, so generally pretty good. Good. That's good to hear that. That's great to see that for the most part. A couple 1s and 2s. All right, and then one more chat storm. 1 to 5. How frightened are you of building financial models? 5, I'm very frightened. 1, not frightened at all. How much do numbers scare you? 1 to 5. 5, they scare me like crazy. 1, they don't scare at all. All right, someone, let's see if I can repost it. All right, somebody asked me to repost the link here. So I think if you come in after the first time it's in there. So we've reposted it a couple of times. All right, so let me see what I got here. I got a couple of 5s, 4s, a couple of 1s. They're very confident in their numbers. That's good, 4s, 3s, 4s. Okay, good. So a nice little mix here. All right, good stuff. Okay, to get started today, I'm going to be showing you both a template of a model, which is without numbers. And I'm going to go through that relatively quickly just to give you a structure behind financial forecasting. And then I'm going to walk you through some numbers. I think that's the easiest way to explain the model and get you to be able to use it. A couple of caveats with it. One is I tried to make this as simple as possible, as easy as possible to enter numbers in, to make it so that someone who doesn't have a lot of experience in financial forecasting or Excel or numbers can learn how to use it pretty quickly. That said, you know, it is a starting point, a template. For those of you who know a lot of shortcuts to Excel, all those things, you can certainly change it up as much as you want. And normally I would have put in a lot more shortcuts, but again, I wanted to keep it as simple and easy for data input as I could with it. The second thing is, you know, if you are scared of numbers, if you are scared of the financial side of things, you got to get over it, because at the end of the day, everything about your business model, everything that you do eventually comes down to numbers, right? And so it's all going to come down to numbers at the end of the day. So you've got to understand this. This is not something you can outsource to somebody. It's not something you can let someone else do. These are your numbers. This is your company, your startup, you're part of it. You've got to understand the numbers. Okay. So with that, I'm going to jump right in to this model. Okay. And this is something that I've been shaping, reshaping, building on, taking away from for the last, I don't know, 5, 6, 7, 8 years since coming to American University. I give this model to startup companies. I do coaching at 1776. I work with a couple of companies. I live in Netta project. I use the same model. So everything I'm doing today is something I give startup companies. I also use in the classroom, and I keep building on it, changing it, making it hopefully a little bit better, a little bit easier as we go through it. So I'm going to just walk you through the structure to it first, real quickly, and then go through a sample with you so you can see some numbers, and then happy to answer questions along the way as we go through this thing. All right, so when we look at the top level part of the model, there's an instruction. I've got different worksheets that go across the page here for it. There's an instruction page that can give you some, some top level instructions, a couple of top level ideas. Probably the most important part of the Excel model is anything in green are numbers that you can change. Anything in green are numbers that you can change. None of the formulas are protected. So if you're changing something outside of a green box, those are all formulas. If you change a formula, if you know what you're doing, fantastic. If you don't know what you're doing, you want to stick with the green boxes, okay? So anything with a green is what you can change. Anything in purple is where you can change words, okay? So I've set up some places where you can put in different naming conventions or assumptions that you want to write up, different pieces to go into. So that's the most important thing to understand with a financial model. So if you go across the bottom here, I've got different worksheets for different pieces. One worksheet is the startup cost inputs, and I'll go back to that in just a minute here. The second is the revenue model, okay? And I have this broken out into 3 years, year 1, year 2, year 3, by months, okay? And I'll come back to that in just a second. I also have cost of goods sold done by each of the different revenue streams, and I'll come back and show you what that means in just a minute. I have an income statement of the revenue streams, and I'll show you what that means here in just a minute. Again, going out all 3 years. And I have fixed costs that go into the business model, again, for all 3 years for 36 months going all the way out. So you can see a lot of green boxes here, places where you can put numbers. I also have a very up and down cash flow model here, sort of cash in and cash out. And I'll explain what that means in just a minute here. These are the 2 main places where you're going to be inputting numbers, okay? Well, these 3, startup costs, revenues, cost of goods sold, and fixed costs. That's kind of it in terms of where you're going to be inputting a lot of numbers. Everything then rolls up into a forecast. There is a 3-year forecast of all of those items that I just showed you, and I'll go into again in detail on it. I created an escalator program for year 4 and 5, which I'll explain in just a few minutes from here. I also have created a graphic for you, so you can have something you could drop right into a presentation slide if you want to, or use another thing so it all comes out graphically. I have a real simplified cap table, and I'll explain how that all ties into these models here to give you a little bit of help. I do have a break-even analysis. This is a little bit more tricky, not as useful for us, because if you have more than one product or service, it kind of gets a little bit skewed, but I did set it up if that's something you want to use. And I have in the end here some calculators and some other helpful things that you can use to help you create some of the numbers. So that's just a quick little orientation to the model. So let's go back to the beginning here. And let's start with our startup cost. All right, this is the beginning. Again, anything in purple are words that you can change, and anything in green are numbers. So these startup costs are costs that I'm assuming before you want to start to build your model. So these are things that you might have before you go to month 1 of revenue coming into your particular model. So you would list out any of the startup costs that you might have. And again, I just listed some here. These have no meaning at all. I just gave you some prompts that you could consider using. You'd put the dollar figures in here and then writing your assumptions here for this, okay? Writing your assumptions. These numbers do not show up in your financial model. These are a separate little category that we have that's outside of the 3-year, 36-month model that we have here. All right, let's go into the meat of it here. So the first thing we want to understand is our revenues and the money coming into the business model. I set up 3 different revenue streams for you, to start from and to work from. And again, you can rename these. You can call these whatever you want because they're in purple. So you can do whatever you want to with them in terms of changing those up. I have set these up in terms of units for you, okay? These are not dollars. These are units that you will be selling. So the units go here, month 1 through month 12, year 2, same thing for all the way through month 36 or month 3. I've also created a price per unit for you here. I have a placeholder of 1 cent for all three of the revenue streams. The reason why I do that, if I had 0 in there, the spreadsheet gets a little whizzy on you and you have these little divide bys and all these little words in there that would throw people off. So I just use that as a placeholder to keep that from showing up in sort of a whizzy form that might mess people up. So I created 3 revenue streams. You may have more, you may have 10, 20, 30, 40, but again, just keeping it simple, sort of a starting point for you to input information in here. One thing I did do with the 3rd revenue stream is I created a subscription model. Okay, some of you might be using that as a means for a revenue stream. So in this case, you have an opportunity to add new subscribers, and maybe you lose subscribers. So maybe in month 1 we add 10, and in month 2 we add 5, and in month 3 we add another 10. But in month 2 maybe we lose 2 of these, and maybe in month 3 we lose 4 of those. So this just helps us understand that process, because if you do have a subscription model, one of the first questions people ask is, what's the attrition rate? How often, do people re-sign up? How many customers do you lose every month or every year? So this is a nice, easy way to set that up from that perspective to show in your minds gains and losses over that particular subscription model. Okay? I have an assumption box. You always want to write down your assumptions on why this revenue stream, what is it? What are your assumptions behind your growth strategy? Again, when I show you numbers, it's going to become a little bit clearer when we look at some numbers here. You're also in this part of the spreadsheet is going to show your cost of goods sold. A cost of goods sold is tied to each unit that you sell. So every unit of revenue may or may not have a cost of goods sold. A product will have cost of goods sold because it costs you money to make that particular product. A service might be a little bit different. You may not have very much cost of goods sold. If you were selling, if you got an app, you can't amortize the coder's time to go into building that app. We would put that cost in a different place here. So always think about cost of goods sold as a per unit cost. So if my revenues, for example, is $100 up in revenue stream 1, I may have cost of goods sold of 40 and 20 and 15 here. That's how much it costs to make that one unit that I'm able to sell at $100. So in this case here, my cost of goods sold is $75. It cost me $75 to make one unit, and I can sell that unit for $100 based on the assumptions that I provided here. So assumptions are very important to include in here, to write those up as part of what you're doing here. And this goes out for year 2 and 3. So you may change your price per unit. You're certainly going to change the unit sold, and we'll come back to that when I show you an example, and your cost of goods sold. So the same thing here going out for year 2 and setting it up for year 3. One thing you may want to note is as your sales go up, your cost of goods sold should go down a little bit because you're getting volume pricing. So if I'm having to buy 1,000 widgets, this year, but because of my growth, I'm going to buy 10,000, I should get a better price for that. So your cost of goods sold should go down a little bit every year because you're getting better pricing, better volume pricing from those particular things. So these are the input variables, and I've got them for all 3 revenue streams, the cost of goods sold for all 3 of them. And again, they go way out. Clearly, there's some shortcuts that can be done here. But again, I wanted to keep it real simple so folks could line up each year's revenue with each year's cost of goods sold, and the number of units for each of those different revenue streams would be inputted here. Now, these then jump to our income statement and fixed cost statement. So these numbers will automatically calculate for you up here. So your revenue stream number 1 pulls, if you look up in the bar up here, this is the formula in here. So it's pulling from that particular page, and it's bringing in my price times the number of units. So you'll see this going across for all your revenue streams, however far out you go for the 3 years, okay? And your cost of goods sold will pull over also along that. So these will be the aggregate numbers that pull over for each of the months that you have here. What's an important number that's going to show up here is going to be called your gross margin. And this is your revenue, your total revenue for that month, minus your total cost of goods sold for your month. That gross margin number is really important because that's how much you have left over for all of the other expenditures you have in your business. All of your other expenditures are everything else, your employees, your contractors, your office rent, office supplies, office equipment, your marketing strategies, internet storage, legal, travel. I put together a lot of placeholders in here for you, but clearly you can change these to reflect what your business model is. But I just gave you some things to start with. And then you will plug in your cost for each month of these fixed costs. So maybe I'm paying my employee number one for, let's make it a little bit more than that, you know, $2,000 a month. And maybe I'm paying my contractor $500 a month, and then so on and so on out for the 12 months. So this is how you input it in. Again, clearly there's shortcuts to do this to make it a lot faster and easier. But I do this so you can understand each month's numbers, and your business model may be seasonal, right? You may be changing up things. Maybe we pay more at certain times or less based on your particular business model. But again, these go all the way out for 3 years in terms of this cost forecast. There's also an important number here called fringe benefits, okay? And for a startup company, we usually don't have too many fringe benefits, but if we do have employees, if we do pay employees, we do have to pay Medicare, Medicaid, half of Social Security. So this number actually might come out to be about 12% of employees. So I've only taken this number on these numbers here for employees. So it's only a percentage of employees. So if you add more employees, you're going to have to adjust this formula to reflect that. So this amount is only taken on this. As you grow, and if your business becomes better and more hopefully profitable, you may add more fringe benefits like healthcare or a 401k plan or other things that might come into play for that. But a startup, usually will need about 10 to 12% just to pay for those things that are required by law. So once we see all this, the numbers will come out and we'll have a total operating profit number, which is our revenues minus our cost of goods sold minus our fixed costs. So that operating profit or loss is all of our revenues minus all of our costs that go into it. And then I've just created a percentage too. And again, you'll see these when we look at the real numbers here coming up. I also have a pro forma cash flow statement, which shows the cash, the money coming in and the money going out. And this is going to become really important to us when we look at how much money we might need to raise to finance our business. And I'll come back to that when I look at some numbers here. But something that's really important conceptually is that the way this model is all lined up right now is that all the revenues are earned in that month and all of our expenditures are paid in that exact month. So everything is a simple one-on-one relationship. Now in the real world, it may be different, right? You may collect money from your customers 30 days in advance. Well, that means you're getting that money a little bit earlier than when you may have to pay your expenditures out. I did a lot of government contracting in my career. I would have to pay expenditures sometimes for 1, 2, even 3 months before I would get paid from the government to get paid back and reimbursed from that. So that's a different sort of cash flow model. So for our sake here right now, everything is lined up straight up in the month, but in reality, those numbers will be different based on what your particular business model may be in terms of cash coming in and cash going out. But again, I wanted to keep it simple and easy for folks to enter it in. So I'm going to stop right there because then everything else calculates for us. That's the only places where you're inputting numbers in. Your startup costs, okay? Your revenue amounts and pricing. I'm going to bring these back to 0. And your cost of goods sold on a per unit basis, and then whatever fixed cost you have up here. So that's it, right? That's your input variables for everything. So there's year 1, you do the same thing for year 2, and then the same thing for year 3 in terms of that, okay? So any quick questions on that before I actually go to showing you what the numbers look like? Because I think that would be helpful to sort of demonstrate what it would be in terms of that.
Hey, Tommy, we have a question from the audience.
Okay.
Do startup costs flow into the cash flow statement?
It does not. Nope, it's separate right now, but you can certainly add that in if you want to. You could drop that number in month 1, or what some people have done, you can start your revenues at month 1 if you want to, or maybe you start your revenues at month 6 or month 9, and you include those startup costs in months 1, 2, 3, 4, 5, 6. So then you have no revenue coming in, but you have those costs in those early stages. You can do it that way also. So you put those startup costs in months 1, 2, 3, 4, and maybe you start your revenues, earning your revenues in month 5, 6, 7, or whenever you want to. And that's another way to calculate that particular number.
Great. And we seem to have another same question from a couple of people. For service-oriented businesses, how do you calculate the cost of goods sold?
For the most part, it's very minimal. In fact, you could just get away with probably your credit card bill cost. So if you have to pay Amex, 1 or 2%, that might be the only sort of transaction that goes that would be a cost of goods sold, because everything else is going to go on your fixed costs. Your coders who's writing your code, your web designer, you can't amortize that out over all the downloads of anything like that. So those costs would just go into a fixed cost. So for a service business, you're going to have very, very limited cost of goods sold. It just makes more sense to put most of those costs into fixed costs. You can't really go wrong with this. It's not a yes or no overall. But when you have a product, you really want to make sure that you're capturing those costs. How much it costs for that particular unit to go with it. What if you have hourly employees? Do you put those in cost of goods sold or fixed costs? Again, it depends on what they're doing. If they are working specifically on building that product, and you can amortize that out over a per unit basis, you can do that. The easier thing would probably be to put them under fixed costs, because then you can say, I've got somebody who works 30 hours a week, I'm paying them $15 an hour, and then put that out over by month, however you want to do that. So that might be a little bit easier. How do you do that with a unit for service business? Sort of same thing. I hope I answered that with it. We're not dealing with tax right now. We're only going to operating income, operating profit, or it's often called EBITDA, earnings before interest, tax, depreciation, and amortization. So for startup companies, that's the EBITDA, operating profit, operating income number. They all basically mean the same thing. That's what we're mostly interested in. That's what people are mostly interested in knowing, because everything else sometimes becomes non-cash issues. Taxes become a non-cash issue. You can carry losses forward, backwards. So, what people are really interested in is what that operating profit number, sometimes called operating income, sometimes called EBITDA numbers, okay? So that's where I stop there. I don't go below that line. All right, let me show you the example, because I think that's a great way to start to really illustrate these numbers a little bit better. So what I've created here for you guys is a sample company. All right, sample with numbers is what I call it here. And everything is the same. Nothing has changed in the model structure. I have now just put numbers into it. So what I've created is a company called Lacrosse Sticks Forever, LLC, okay? And so to get my inventory going, lacrosse sticks, I've got some stuff I've got to make. I've got to make and build lacrosse sticks. So maybe I've got some raw material, wood, leather, molding from it. I've got to assemble them somewhere. So I've got factory and staff. I'm actually going to license from the U.S. Lacrosse Association of America. So maybe I've got to pay a little bit of a fee here. Maybe I've got shipping costs, legal costs. So again, these are just things that I might have to help me start my particular business. And so for this example here, I'm saying I need $70,000 to start my company, okay? So here are my two revenue streams. I actually have two revenue streams. My first revenue stream is actually selling the lacrosse stick, and I'm going to sell these online, okay? I'm not going to do a storefront. I'm going to price my lacrosse sticks at $100 for each stick. And these are the number of sticks I'm going to sell. So in months 1, 2, 3, I'm going to sell 50 per month. Month 4, 5, and 6, and 7, and 8, 200 per month. Month 9, 300. Month 10, 11, and 12, 400 sticks a month, okay? I also have a second revenue stream. I'm going to have this practice facility that people can come and just use. I'm going to have nets and, a place for them to, practice shooting on or throwing against a wall. And I'm going to charge a subscription. It costs them $10 a month to use my facility, to use this, to just come and just be able to throw balls and play, practice on it, whatever they want to. So in month 1, I think I'm going to have 50 subscribers sign up. In month 2, I'm going to have another 50, and in month 3, another 50. So this is cumulative. So now I go from 50 subscribers to 100 to 150. Month 4, I think I'm going to add 75. But I'm also going to lose some. Some folks are going to get tired of it. They're going to move away. They don't like it, whatever. So now that number is reflected up here. So I added 75, but I also dropped 10, and so on and so on. My additions each month, and then my negatives each month. This is a great way to reflect subscription models. And, and again, subscription models are great business models if you can keep people in, because they're paying you month over month over month. So we like to see those as investors. All right, I didn't write any assumptions down here, which I definitely should. So let me get back to the cost of goods sold. Let me get to the cost of goods sold. So I say I can price this for $100 a unit. All right, here are my costs. It's going to cost me $10 of raw material for each stick. It's going to cost me $40 to assemble everything and make everything together. It's going to cost me $3 to ship it to a distribution center. It's going to cost me another $2 to ship it from the distribution center out to my customers. So every lacrosse stick is going to cost me $55 to build, make, and ship. I sell it for $100. It costs me $55 to make. So my gross margin is, or my cost of goods sold cost is $55 on each of those, which means my gross margin on each lacrosse stick is $45 or 45 cents. So what that means is 45%. That means I've got $45 to spend on everything else, all of my other costs, and hopefully get to a profit on a per unit basis. So I do this all the way out for all 3 years. So here's year one, okay? Here's year two. And again, I'm increasing my units sold. I could change my prices, right? I could change this to $90 if I want to. I could change it to $150, whatever you think, right? These are forecasts. These are your numbers. And then I increase my per unit sales here. I also increase my subscription models, going up each month. And I change my cost of goods sold because, so for example, it was $55 here for year one. For year two, it's going to go down a little bit because I'm selling more cross sticks. I can get better pricing. It's not going to cost me $10 per stick. I can do it for $9. It's not going to cost me $40 to make. I think I can make it for $37 because I'm getting more efficiencies. I'm getting more effective in terms of what I want to do here. I'm sorry, I didn't show my last cost of goods sold, which was the practice facility. And again, this is pretty low, right? There's not a whole lot here that I can really amortize out on a per subscription basis. So I just said $2, which maybe that's for, some wear and tear or, paying by credit card or something like that. There's really not a lot I can do with this because I've got this facility, this field and things that are on it that, it doesn't really matter if 10 people are on it or if 200, it's hard to get a cost of goods sold, which is fine. And I'll show you in a minute where I put those actual costs on it. So this is set up my revenue models and my cost of goods sold. So now these numbers are showing up, right? So my revenues, oops, let me go up to the top. So my revenues are now calculating off of those sales in terms of that 50 lacrosse sticks times $100 a stick gets me to 5,000, okay? And so on and so on and so on, all the way out for all 3 years, right? These numbers are showing up here. Same thing with the practice facilities, right? I'm not going to drill into them, but same thing, right? These numbers are showing up all the way out here. Same thing with the cost of goods sold for each of those streams. Those costs are being captured, and then they're showing me the bottom line down here. Now, this gross margin is an average, right? It's an average of the 55% and 20%. So my revenues for month one is $5,500, adding these together. My cost of goods sold is $2,850. So my gross margin is $2,650. This is the amount of money I have at the end of those sales and cost of goods sold to pay for everything else in the business for that particular month. So here are my costs. Ooh, I've given people some names. It's no longer employee number one. It's the CEO. It's the chief marketing officer. It's the director of projects and marketing. It's marketing and sales manager. It's website manager. I've given some names to our folks here, and I've given them some salaries, okay, in which to live off of. Not market rates, right? We're a startup still, but money to pay, to pay ourselves to pay our bills and live off our bills. So again, these costs go out all the way out to 3 years. But the one thing you're going to notice is as we're growing, I kept some of these zeros in here, right? I kept these in here just as placeholders because as we grow into year two, I'm starting to add some more people in here, right? I'm adding some more folks to participate as part of the team. And then year three, look, I've added more. I've increased my costs in marketing and other things that go into it. So I want to demonstrate that my costs are going up along with what I am doing here. So again, I just have placeholders for different things. The one noted one is here's my practice facility, rental and maintenance, $3,000 a month. So I consider that a fixed cost because again, it doesn't matter if I have 10 people using it or 100 on it, I still have to pay $3,000 a month for this particular facility. So that's where that goes in terms of that number. And I've increased it as we go along because I think we're going to expand. All right. And then the other costs, the marketing, advertisements, things like that go into those numbers. So now I've created these numbers. And let me just stick with month one because that's easy to look at. So my revenues for month one is $5,500. My cost of goods sold is $2,850. What I have left is $2,650 to pay for everything else. So when I add up all of these costs here, my total fixed costs come in at $26,000. So when I add that to my cost of goods sold of $2,850, my total costs are $29,470. So I'm losing money, right? $5,500 minus $29,500 gives me a negative number of $23,970. So I'm losing money right now in month one. Okay? I'm losing money in month 2. I'm losing money in month 3. I'm losing money in month 4, 5, 6, 7, 8, 9, 10, 11, 12. I'm losing less money each month, but I'm still losing money each month. And I'm going to come back to that in just a second to explain this a little bit and financing and funding. So each month I'm not profitable yet, but I'm getting better. And the reason why I'm getting better is that my sales are going up. My revenue is increasing up. And so I'm still losing money, but I'm losing less money along the way. In year 2, same thing. I'm losing money again in year 2. In fact, it goes up a little bit in terms of my operating loss because I've added some other costs to my structure here, but it goes down. And then if you look at, sorry for a second, if you look at a couple numbers here, and I'll explain these in a minute that I have in yellow, something magical happens. I go from losing money in month 16 to making money in month 17. And voila, in month 18, 19, 20, 21, 22, 23, 24, 25, 26, my operating profit is now positive. I am out of the negative and I'm getting more and more profitable every single month along the way. So I'm going to come back to that, what that means, and what does this mean for us implication-wise when we start doing what-if scenarios, because that's what we do with our financial models. We do what-if scenarios. I'm going to hold on this cash in and cash out for a second. I'm going to come back to it. I promise you. So now we've inputted in all of our numbers, right? We put in all the numbers in green. Now I want to look at it in an aggregate, right? So now I can see it, the big picture, what it all looks like. These are all the categories, all the revenue, cost of goods sold categories, all the fixed cost categories for years 1 and 2 and 3 summarized on an annual basis. So now I can see the big picture here, right? I can look and see that I'm doing $265,000 in revenue in year 1, 1.8 million in year 2, 1.9 million in year 3. I'm sorry, for lacrosse sticks. My totals are down here for all of my sales. All of my cost of goods sold here for each of the 3 years are here. All of my fixed costs are here with it in terms of that for the 3 years. My operating loss for year 1 is negative 159,000. When you add all those 12 months together, I turn profitable in year 2. In year 3, I turn even more profitable in terms of that. So this is a great way to sort of see things in aggregate and to give you a good view. It's really important to look at this because sometimes you're going to make mistakes. You're going to go into your fixed costs and, you know what, instead of saying 3,000 a month, you might type in, 300,000 by mistake. And by looking at your 5-year summary, all of a sudden, you can begin to see where that error might have, oops, sorry. I'm at year, I look at year 3 year. Where that error took place. So all of a sudden, whoa, wait, I've got 333,000 in year 1. Something's wrong with that. I must have made an error somewhere. So you can go back and look and you say, oh, I really meant to write 3,000, right, in that. So I can go back and fix that. So it's a great way to see it visually, the whole thing, the 3 years. Now, I added a year 4 and a year 5. And I added what I call an escalator here. And so I didn't calculate out year 4, year 5. You can certainly do that. You can add year 4 and 5 way out on your spreadsheet as far as you want to go. But what I said was something a little bit different here. I said year 4 from year 3, I'm going to grow it 30% over year 3. So if I change this 1.3 to 1, you can see that year 3 is the same, right? It's the same all the way across here. So, and then if I put this to 1 also, you can see it's keying off of year 4. So this is just a fast way for us to get to year 4 and 5. So if I think I'm going to grow at 30% from year 3 to year 4, I can say 1.3 roughly. If I think I'm going to go from year 4 to year 5 at 1.5, I can do the same. Now it's a little bit off because I also escalate this at the same number. So it's not quite accurate, but it's actually accurate in the wrong way. It's being more conservative because I didn't make adjustments for that. But it's okay. I think it's all right to do that. In the fixed costs, I do have different numbers here. And the reason why I use different escalators here is your fixed costs should not go up at the same relationship as your revenues do because you should be getting better. You don't need as many resources. So here I might say, if I'm going to go up at 30% from year 3 to year 4, maybe I'll go up 15% in terms of additional costs, fixed costs from year 3 to 4, and then 20% from year 4 to 5. So it's just a nice little way to capture it really quickly. You can certainly do the calculations if you want to, but I decided not to do that, make it easier for you to do year 4 and 5. Then it all comes out nice graphically for you, so you can see it. You can see the revenue lines are in green, and the all of your operating profit or loss. You can see 1.59 loss here, and then your profit, and then we get more profitable as we go through in terms of your different years. So this is a nice graphic that you could, you can put that into a presentation if you want to, or something like that in terms of that. All right, let me talk about 2 more things here to give you some understanding of yeah.
Sorry, Tommy, we do have a question from the audience.
Okay.
If we want to add additional revenue streams, do we have to edit any of the formulas in the sheet so that all revenue streams are accounted for on subsequent tabs?
Yes, you do. So, and this is why if you know what you're doing, go for it, right? Rip this sucker apart, put it back together. But yes, you will have to add more. You have to add more revenue streams. Let me go back to here. You could either do them here, you can add them up in here, but remember, you got to add cost of goods sold also to reflect that. You would need to go into your income statement and add another row here, make sure it all totals up down here. And you'd have to add another row into your, to your revenue streams up here and cost of goods sold. So yeah, you'd have to adjust it about five different places to make sure it all gets captured. Okay. All right, let me show you one more thing and why this can be helpful to us from, from understanding how much cash we might need to start the business. So remember, we showed you this loss here for this first year of totals $159,000. Well, what we want to understand is how much money then do we need to finance our business? How much money do we need to raise if we're operating at a loss? If you're operating at a profit from day one, you may not need to raise any money, right? Because you're already profitable. You're already using that money to help you pay for your business model. But if you are a business model that's going to operate negatively for a while, you have to have investment come in. You cannot operate a business without cash. If there's one thing we've learned in COVID-19 is that cash is extremely important for a business. You cannot run a business without cash. So when I think about this from a cash flow standpoint, what I do is I do this in and out, right? This cash in is my revenues coming in. This cash out is my total cost coming out. And right now, these monthly endings equal my operating profit or loss. And that's again, because I've lined them all up in the same month, And so when we do this, what we're really looking for is that cumulative number, because this is going to help us decide how much money we need to raise to help us cover that loss. Because I'm just not losing $23,000 overall. I'm losing $23,000 in month 1. Then I lose another $23,000. So now I've lost $47,000. I lose another $23,000 in month 3. Now I've lost $70,000. In month 4, I lose $15,000, but now I've lost $86,000 because it's a cumulative number. And this becomes very important because I've got to understand how much cash I need to make this business run for a particular period of time. And in our case, and the reason why I highlight these numbers in yellow, this is where we break even for the first time. Between months 16 and 17 is where finally our revenue is greater than our cost. And so by doing that, we are now starting to become profitable. So here, if you look at month 16, we lose 4,400, but in month 17, we make 6,540. So somewhere between those 2 months, we become profitable. We start making money. And so this becomes really important because we have to understand how much cash we need then to run this business. And so I always look at the lowest cash dollar amount cumulative number. So that's going to be negative 183,000. That's adding up all 15 months or 16 months of our losses, because in month 17, we turn profitable. So I need to run this business for 16 months. I need at least $183,430 to run this business, because I can't run this business without cash. Now I want to have a little bit of a cushion because projections are wrong, right? So what I would put into here then, and I had this number in here early, I would put in about a 20% cushion. So when I do that, This is my starting cash balance in month one. This is the cash that I have in the bank, and I can use that cash to pay for all 16 months that I lose money. So now what happens is that our income, our loss stays the same, right? That doesn't change, but now our cash balance changes because I start with a positive number of 220,000. Now every month, this number is getting less and less because I have to fund this loss. I have to pay out an additional 23,170, additional 15,000. So my cash balance keeps going lower and lower and lower, but it's okay because right when I get down to my 20% cushion, I start to become profitable, and now my cash balance is starting to go up. Okay, so this is one way for you to start to figure out how much money do I need to run my business. And then it starts to figure out how, for those of you who are working on a cap table or a valuation table, how do I start to figure this out? Well, let me continue this. And what I've created is a really, really simple cap table, folks, all right? Very simple, but it's a great way to sort of start out this analysis, because I often get people saying, well, what's my pre-money valuation? What's my post-money valuation? How do I calculate this stuff? Well, let me show you one way that you can do this. So here's my capitalization table. I have two owners who start the company. One is Michael Jordan, and since I went to UNC Chapel Hill, I have to have Michael Jordan in there. The other is LeBron James, and we've gone into business together. But since Michael Jordan is a better negotiator than LeBron James, he has more ownership of the company. So he owns 60% of this company. LeBron James has 25%, and we agreed to put 15% into an option pool for future employees to actually get some ownership. Okay, that's the starting point of this ownership. So think of it as founder one, founder two. Okay, then this is an important number here. So this number here actually pulls from two numbers. This number pulls from my 70,000 startup costs. If you remember that at the very beginning, I said I need $70,000 to start this company. And then it pulls from this number, how much capital I need to invest. So that number is adding those two together. So what I'm saying is I need $290,000, which is the 220,000 plus the 70,000. I need $290,116 for my startup costs and to run this business for 16 months. It's my runway of 16 months before I turn profitable. Okay, before I turn profitable. Now, when I put that number in there, what you have to figure out then is, if I need $290,000, how much equity am I willing to give up for that $290,000? I often hear people talk the other way around, which is, how do we set a pre-money? How do we set a post-money? I like to look at it from the other perspective, which is, I need $290,000. How much ownership am I willing to trade for that investment? So in this case, I put in 20%. Okay, I'm willing to give up 20% of our company, LeBron James and Michael Jordan, willing to give up 20% of our company for an investment of $290,000. When we put those two numbers in, our pre-money and post-money automatically calculate. So our pre-money, we're saying, is $1,160,000, and our post-money after the investment becomes 1.4. So it kind of takes those calculations out for you to focus on what's really important. How much equity I'm willing to give up for the amount of money I'm willing to put into it. So if we go with 20%, then Michael Jordan gets diluted down to 48%, from 60 to 48. LeBron James gets diluted from 25 to 20. The option pool gets diluted from 15 to 12. And we decided Kevin Durant would be our new investor, and he comes in at that 20%. So this is the new cap table now. This is the new ownership structure after this 20%. I could also change this to 15%. All right, I'm willing to give up 15% ownership for this investment of $290,000. So my pre-money gets automatically recalculated as to my post-money. Kevin Durant may be really hard negotiator, and he's like saying, no way, that's way too low. I really want 25% of the company. All right, so now that goes in at 25%. So now the pre-money is lower, 870. The post comes in at 1.6. To me, this is a really good estimator tool to start to figure this out without having to do all this fancy work with post money, particularly for an early stage company. This gives you the tool to start to think about strategically, if this is how much I need, how much am I willing to give up in terms of ownership, or negotiate? That's probably a better word. How much am I willing to negotiate? And you know, your ownership is probably going to fall somewhere between 10 and 25%, you know, for something like this. Okay. So that's a great way to sort of help you sort of with an early stage to sort of start to figure that part out, because I do get a lot of questions on this. Please note that this capitalization table is just for illustrative purposes and there's no binding agreement, particularly when you start to do this with a founder to start playing with this a little bit. You want to make sure that this is just illustration only and not a binding agreement until you get to your documents and stuff. Okay. Boy, was that a fire hose, man.
Hey, Tommy, we do have a few questions from the audience.
All right, we got what, 15 minutes to do that. So I know that was a lot to cover here. Yes. So fire away. What do you got for me?
Okay, great. Well, Jessica, I'll start from an earlier one. She says, I struggle with coming up with the numbers for my financial planning. How do you determine that for a new concept you are introducing to the market? We could do really well quickly, or it might take a lot longer than expected. Would love your thoughts on this. People seem to predict big numbers.
I think your first part of your question is, how do I come up with the numbers? Is that correct? Like, how do I, for me, yes. The best thing to do is the more data you can find, the more you can get, quotes from people, where you can get real numbers is better. Okay. Then the second level is assumptions. Okay. I'm assuming this. I couldn't find real data on that, but I'm assuming this. But what you don't want to do is say, well, we need a facility. I think it's going to be about 5,000 square meters. I'm going to estimate $50, a meter. No, you want to see a quote. You want to see how much it's going to cost, because putting up a facility in, Leesburg, Virginia is going to be very different than putting up a facilitator from a facility in, Washington, D.C. All right. So the more you can have real numbers, the better. And let me state this, and I should have stated this in the beginning, but it's probably better towards the end here. Folks, first and foremost, these numbers are for you. All right. This is for you to figure out your financial model and your business model. Everything you do, your product you're building, creating it, your marketing plans, your costs for marketing, the people you're hiring, how much you're paying them. This is for you. You need to figure out this. This has to be, you got to be confident on this when you do this. You got to feel good about these numbers, because if you don't feel good about the numbers, there's no way an investor is going to feel good about these numbers, right? So you've got to go in, and your first audience for these numbers is you and your team, hands down. Okay, hands down. You can develop different scenarios here if you want to, in terms of it. And again, this is about what if. If you're to look at real quickly, I'm going back to my example here. If I were to look at my revenue assumptions, come on, here we go. If I were to look at my revenue assumptions for, oops, I'm in the template, sorry. Let me go back to my sample. All right. So for example, one question I would ask of this, okay, I did a straight line, right? Kind of a straight line increase every single year, year over year. Well, a prudent question would be, well, when's the lacrosse season? When are people most likely to buy lacrosse sticks? Well, lacrosse is a spring sport. So maybe if month 13th is January, well, this might be my big selling season, right? January, February, and March, okay? I may not sell any lacrosse sticks, or very few during these months. Holidays is a big time for lacrosse sticks. So you have to think about those things in terms of your particular business models of what makes the most sense for it. So this is where you start doing what if scenarios. So you want to get that first foundation down first, and then you start to play with the numbers. And that's what we call what if scenarios. And you could call them high-low, you could do one that's lower and one that's bigger, whatever that works from you, is fine. But this is, you got to get that foundation going first.
We also have a question asking about convertible notes. What about convertible notes?
Yeah, I haven't built that out yet. That's kind of my pony trick number 2. I've got to put in there. And that could go more just on the cap table in some way. I'll just have to work that in as an alternative here. The thing is, if you're, and safe notes are mostly convertible notes right now too. You can do all the financial analysis based on what your needs are. That's not going to change of how much money you need. It's now just what's the vehicle you want to do it in. And remember, a valuation is only for an equity investment. In a safe note or a convertible note, you're coming up with a value cap. And that's usually going to be higher than what your valuation is going to come in at. Not a lot, but it's usually going to be a little bit higher. from that. So it's more the tail end of this discussion, like the cap table and what you're going to do with that value. But still, you know, getting all the way to that point there and just sort of figuring out how you're going to change that to a convertible note is what you need to do. But I need to build that out. That's on my to-do list here, is to build out a model that reflects that part also.
Great, thank you. We have a question from Mike. If my business is a marketplace and we earn the commission on the seller's transaction, how do you forecast the revenue?
Good question. You know, because your revenues could be astronomical, right? Because you're putting every single product on there, but then your margins are going to be very slim because you're only charging 8% or 10% or 15 or 5 or 2 or whatever that is. I've seen people do it different ways. You know, I think for your purposes, it's probably good to include the products that are being sold, so you have a better idea of what you're selling. You know, are you reselling books? Are you reselling furniture? Whatever. And I think it's good for you to capture that in your revenue model for you. Whether you show that to investors or not, that's a different story. You know, you may just take that percentage and say, here's our revenue, you know, of you know, $5 million that's pulled off of $100 million in resale, which would be, you know, 5% or whatever. But you need to see that. You need to see what categories where you're pulling that from, because that's going to go back to your marketing strategy and your marketing campaigns, your go-to marketing campaigns of how you're going to get those particular products up onto your site.
Great. Great. Does anyone else have any other questions? For those who are asking if a playback will be available, yes, we will be sending out an email with all recordings, including this class, this session after DC Startup Week. So please keep your eye out via email. I actually have a question. How often should you be updating the financial modeling?
I'm just typing in my my email in here if anybody has any questions. I think I typed it right. Yes. You know, this is a living document. This thing doesn't go away. You need to be, you know, updating it a lot. You know, you want to be a little bit careful though. I mean, you know, one thing I've seen, you know, and it's a complete credibility killer when you have financial statements that say one thing, you have your summary that's in your pitch deck or your one-page summary that says different numbers. You know, everything has to speak the same language or you're out, right? If you've got different numbers, and I've literally been in pitches because I do, you know, I've been an angel investor for over 10 years. I've seen pitches where the entrepreneurs literally says, oh yeah, those are old numbers. Yeah, I'll have to get back to you on that, man. Yeah, done. You're out of here. You know, not even counting. So you want to keep them updated, but when you do update them, make sure you're updating them in places that you are sharing with people. You know, very important. But there's the living document, which is what you're working off of. And then a second one, which is, you know, how that may translate into what you're sharing with outsiders.
That makes sense. We have another question. How critical is financial modeling for startups creating a new market?
For creating a new market, does that mean a market that doesn't exist? You know, kind of like the iPod that we were all very happy with our CD-ROM players 15 years ago. And then when Steve Jobs said, hey, would you like something that's 2 inches square that holds 500 songs? And we're all like, oh yeah, I'll take that. Is that what you mean by new market?
I'm going to unmute Irfan so he can answer.
Oh, hello. Can you hear me?
Yeah.
Yes.
Yeah, so we have a situation where basically there is no existing market for this service. So imagine like how when...
Well, remember, projections are projections. You're going to be selling something, right? So you got to put some numbers to it. And again, folks, this is not, you know, particularly for something new, you know, you want to get as good numbers as you can, but it's still guesswork at the end. And that's why everything flows to your numbers. You know, if you've got this incredible go-to marketing campaign of emails that you're sending out, you know, you need to understand the response rate from that and what you're doing to it and creating that so that you can see those numbers and then start using that as a framework. Once you start getting real data, then you're going to start changing that out, right? You're going to change forecast numbers out into real data that you're basing it from. So let's say your subscription model, let's say you're forecasting a 20% drop rate. Well, after 1 year, if it's only 10%, you better change it to 10%, right? That's a lot better numbers than a 20% loss. So as you go through and you start building up, you're going to start replacing, you know, some some assumptions with more concrete data because you're learning as you go along with it. So even this is a new product or service, you've got to do the same modeling out. So you've got an idea.
It's basically the assumptions you're basically saying. Like the critical thing there is the assumptions what people are interested in looking at, even if they're not accurate.
Yep, exactly. Yep, because you got to start somewhere, right? You got to start with something, but don't give me some pie. Don't do something pie in the sky, because this is something you got to feel like you can achieve, right?
Yeah,
because we have numbers.
Right, because we have like customer acquisition costs as a major factor where we think it's going to be low, but that's a primary figure that we have in mind. Other than that, it's a lot of sort of guesswork, and would be just throwing numbers at the wall. So I said as an example to Ms. Roxy that, like, for example, when Apple created the App Store, there was no App Store before that. So what numbers they had in mind, I don't know, but they knew probably that getting the customer was pretty cheap. And then after that, everything else is sort of like, I guess. So in that case, the assumptions are, after the customer acquisition cost, the rest of it is all assumptions, and those assumptions got to be really tight. Is that what you're trying to say?
Yes. Again, you've got to start somewhere, right? And then you're going to keep changing them. You're going to keep modifying them as you go along and as you get better information.
Okay.
But don't not start because you feel like you're kind of frozen in place, right? And I see that a lot, kind of the deer in the headlights. You've got to start somewhere. You've got to start building this out to get things going, because folks, everything comes to numbers, right? Everything comes to numbers at the end of the day. How you pay yourself, the value of the company, how you're paying everybody else, the profitability. I mean, everything comes to numbers.
Well, thank you so much, Professor White, for that. I think that concludes the end of this discussion. If anyone has any questions for Professor White, we do have the speaker's contact information through the Attendify platform. So definitely find that class, find the session, and reach out to Professor White. That was really, really helpful. And thank you for sharing those documents as well. I think a lot of people in this will be using those right away.
Yeah, and again, for beginners, it's a good starting point. For those of you who go, oh, now I get it, and you rip that sucker apart, that's awesome too, right? And that's the whole point of it. It's just to give you something to start with, and hopefully to say, oh, now I see what I need to do, and and go for it. So
just go for it. It always takes that little bit of courage to dive into those Excel spreadsheets. Well, thank you again.
Guys, okay, anybody has questions, reach out to me. I'm in the platform. What is it? Attendify, I think. And then also email. More than happy to help you as you go with. So good luck. And let's see everybody making some money here. Okay. Let's see everybody making some money.
Sounds good. Thanks everyone. And thank you for joining DC Startup Week. See you at the next session.